Millions of Americans could wake up next week with lower credit limits, frozen cards, or outright declines, even if they did nothing wrong. That sounds extreme, but it is not speculation. It is the direction the system is already moving. For most people, the warning will not arrive as an email or a letter. It will arrive at a register, a grocery store, a gas station, a pharmacy. The card worked yesterday. The balance looks fine, yet the screen flashes declined. Be honest for a moment. If that happened to you tomorrow, what would break first? Groceries, gas, medicine, rent. Comment one word. Here is the reality most Americans are living inside right now. Total household debt in the United States has passed $18 trillion. Credit card balances alone are now above $1.2 trillion, the highest level ever recorded. At the same time, credit card delinquency rates are climbing back toward levels last seen before the pandemic. That combination scares banks. When balances rise faster than incomes, lenders do not wait for a recession headline. They tighten quietly. They lower limits. They slow approvals. They review accounts automatically. This is not about one law or one announcement. It is about risk. Banks do not look at your life the way you do. You see context. They see patterns. You might say, I had a car repair. They see utilization spike. You might say, groceries got expensive. They see revolving balances. You might say, I am paying on time. They see minimum payments. Risk models do not care why. They care how often people like you fall behind. Ask yourself this honestly. Are you using more of your available credit now than you were 5 years ago? Comment yes or no. A lot of families leaned on credit cards because inflation never really went away. Food prices remain more than 25% higher than they were before 2020. Rent is up over 20% nationwide. Insurance, utilities, and healthcare costs all climbed at the same time. Wages did not keep up, so credit became a bridge, not for luxuries, but for basics. Groceries, gas, school supplies, medical copays. Banks see that bridge bending. Recent data shows that the share of credit card balances transitioning into delinquency has been rising steadily. Even more concerning, middle-income households are now the fastest-growing group falling behind. These are not reckless borrowers. These are working families trying to keep up. Here is another pressure point most people miss. Student loan delinquencies surged after payments restarted. In early 2025, millions of borrowers saw credit score drops of over 100 points in a matter of months. Even if you do not have student loans, this affects you. Why? Because banks do not isolate risk. They widen the lens. When one major category cracks, lenders pull back across the board. So if you are wondering why this feels sudden, here is the answer. Tightening happens in cycles. Banks update risk models. Portfolio reviews run. Automated systems adjust thresholds. When that happens, millions of accounts are reevaluated at once. That is why people say, nothing changed, but my limit dropped. Have you ever had a credit limit cut without warning? If yes, comment cut. Here is the part that shocks people. You can pay on time and still lose access. If your utilization rises too high, your score can dip. That dip can trigger a review. The review can cut your limit. Then your utilization jumps even higher overnight. The system creates its own downward spiral. Have you ever watched your credit score drop even though you paid every bill? Comment score if that happened. Now let us talk about interest, because this is where the trap tightens. Average credit card interest rates now sit above 20%. That means even small balances grow fast. A $5,000 balance can quietly add hundreds of dollars a year in interest alone. People feel like they are running on a treadmill that keeps speeding up. That is not poor planning. That is math. Add late fees to the mix. Recent legal decisions kept many late fees higher than expected. That matters because late fees hit when people are already stretched. One missed due date can trigger fees, interest hikes, and account reviews all at once. This is why people fear credit card issues more than price increases. Prices hurt slowly. Credit cuts hurt instantly. Imagine this week. Day 1, your card declines. You try again, slower this time, like that will change anything. The cashier looks at the screen, then at you. You laugh it off, but your stomach drops. You move one item aside, then another, until the total finally goes through on a backup card or your debit. You walk out carrying less than you planned, already doing math in your head. Day 2, you switch to debit and drain checking. The available balance number gets smaller with every swipe. Groceries, a quick stop for toiletries, maybe a small bill on autopay that you forgot was scheduled. By the afternoon, you start checking your banking app more than your texts. You cancel something small, then feel annoyed that you even had to. Day 3, your car needs gas. The light comes on. You tell yourself you can stretch it. You take the longer way home to avoid the highway, then realize that saves nothing. You stand at the pump watching the dollars climb, wishing you could stop at 20, then stopping at 20 because you have to. Day 4, prescription refill comes due. The pharmacy calls. You know skipping is not an option, but you also know the rent is close. You ask the price. You pause. You hate that you paused. You pay it, then promise yourself you'll catch up next week. Day 5, a school expense appears. A field trip, supplies, a fee that always seems to pop up at the worst time. Your kid asks like it is simple. You smile, say we'll see, then stare at the ceiling that night, thinking, how did it get this tight so fast? Life does not wait for the bank to reconsider. If you have ever had to choose between 2 basic needs in the same day, comment choice. Now here is something that does not get talked about enough. When credit tightens, people do not just lose buying power, they lose confidence. They stop raising their hand at work. They stop planning trips. They stop fixing things before they break. Everything becomes reactive. That mental shift changes how people live. They shrink their world. They say no more often. They delay decisions that would have helped them long term. Have you noticed yourself hesitating more before spending, even on necessary things? If yes, comment. This is how financial pressure becomes emotional pressure. And that emotional pressure does not stay isolated. It shows up in families, in relationships, in health. Stress-related sleep problems, anxiety, and burnout rise when money feels unpredictable. Credit cuts act like a shock to the system because they remove choice instantly. Now let me speak directly to older viewers. If you are retired, close to retiring, or helping aging parents, you already know this. Credit cards often act as the buffer for fixed incomes. A dental bill, a home repair, a medical expense. When access tightens, there is no cushion. Do you rely on a credit card as a backup plan? Comment backup or no. Automation makes this worse. Banks now use real-time fraud detection and spending analysis. Buy something unusual. Travel. Spend more than normal. Your card can lock instantly for safety. Sometimes that lock comes at the worst possible moment. Have you ever had a fraud alert freeze your card when you needed it most? Comment it. Now connect everything. High balances, rising delinquencies, student loan stress, high interest rates, automated risk systems. That is why this moment feels different. This is not about panic. It is about awareness. So what can you actually do right now? Reduce utilization if possible. Living near your limit signals stress. Avoid minimum-only payments when you can. Even small extra payments matter. Set autopay for at least the minimum. One late payment can start a cascade. Avoid cash advances. They are strong distress signals. Build a small cash buffer. $200 buys time. 500 buys options. 1,000 buys breathing room. Which number feels realistic for you in the next 30 days? Comment 200, 500, or 1,000. Here is the bigger truth. Credit cards were never designed to be survival tools. They became survival tools because prices rose faster than income. Now banks are pulling them back because survival looks risky. That contradiction defines this moment. If you are tired of being blamed for a system that got more expensive, you are not alone. If this video made you rethink how fragile credit access really is, share it with someone who relies on their card more than they admit. Hit like if you want early warnings instead of late surprises. Subscribe if you want straight talk about money, inflation, and the quiet shifts that hit regular families first. This channel is for people tired of being told everything is fine while the rules change under their feet.